The third financial ratio is the solvency ratios. It is also called as financial leverage. It compares a company's debt level with its assets, equity, and earnings to evaluate the likelihood of a company staying afloat over the long haul by paying off its long-term debt as well as the interest on its debt. In other words, sa solvency ratio, inaalam natin yung kakayahan ng company na mabayaran ang kanyang mga long-term liabilities. Example of solvency ratios include debt-to-equity ratio and debt ratios. The debt-to-equity ratio. It shows the relationship between debt and equity, or total liabilities divided by total equity. Take note that the higher the debt of a firm or liabilities in relation to its equity, the more leverage it has and the more risk it has assumed. On the other hand, lower values of debt to equity ratio are favorable, indicating less risk. So, here are the guidelines para ma-interpret at ma-evaluate natin ang result ng debt to equity ratio. If debt to equity ratio is less than 1, it means that more assets are financed by shareholders' equity. If it is equal to 1, it means that half of the assets of the business are financed by debt and shareholders' equity. So, balance yung utang and fund provided by the shareholders. On the other hand, if debt to equity ratio is greater than 1, it means that more assets are financed by debt. And kapag nado sa sitwasyon na yon ang isang business, they are highly related to financial risk, or possible na humarap ang isang negosyo sa tinatawag nating financial risk. When we say financial risk, ito yung klase ng risk na maaring hindi na makabayad ang isang kumpanya sa kanyang mga long-term liabilities. So here's the debt to equity ratio of Tyson Foods Incorporated for year 2013. So the total liabilities for year 2013 is 2,404, while the total shareholders' equity is 6,233. Meaning, the debt to equity ratio is 0.39. It indicates that the firm have 39 cents of debt for every dollar in equity. The next solvency ratio is the debt ratio. It indicates the company's ability to pay off its liabilities with its assets. It is also known as debt to asset ratio. And the formula to find debt ratio is debt divided by total liabilities. Yung debt na tinutukoy natin dito is the total liabilities. Take note that for firms where investment in long-term assets is high, leverage can be higher, like in the manufacturing industry. For services firms or service firms with little capital investment, the leverage level can be lower. So, yung leverage ay depende pa rin kung saan kabilang na industry ang isang organization or isang business. If the result of debt ratio is less than 1, ibig sabihin nun, less risky, financially stable, may enough na pangbayad ang business sa kanilang maturing obligations or long-term debts. On the other hand, kapag equal to 1, it means that the company would have to sell off its assets to pay off its liabilities in case na mag-mature lahat ng kanilang utang. If the value of debt ratio is greater than 1, ibig sabihin risky dahil most of its assets are financed by long-term liabilities or mostly ang ginagamit nilang pondo ay galing sa utang. So the fourth financial ratio is the profitability ratio. These ratios convey how well a company can generate profits from its operation. So profitability includes profit margin ratio, return on asset, return on equity, return on capital employed, and gross margin ratio. So itong lahat ay example ng profitability ratio. For this course, for this discussion, we will focus on gross profit margin, operating profit margin, net profit margin, return on assets, and return on equity. So gross profit margin measures the profit before operating expenses, interest, and taxes are subtracted. It is a ratio of gross income to sales, and it indicates how much of every dollar or peso of sales is left after the cost of goods sold. So yung cost of goods sold, ito yung difference between revenues and cost of goods sold, or rather, gross income is the difference between revenues and cost of goods sold. So the formula in finding gross profit margin is gross profit income or gross income divided by sales. So based on the financial data of Tyson Foods Incorporated for year 2013, the gross income or gross profit is 2,358. Then divide it by the sales or total sales, which is 34,374, which provides us the GPM or gross profit margin of 0.07, which means that for every dollar generated, $0.93 would go into the cost of goods sold, while the remaining 0.07 So based on the given value or financial data of Tyson Foods Incorporated, net income is 778 divided by the shareholders' equity for 2013, which is 6,233. The return on equity is 0.07, which means that for every dollar invested in Tyson Foods Incorporated, investors would generate 0.07 cents. Thank you, and that's the end of lesson 3. For questions and clarifications, you may directly communicate with me through my messenger account or through our group chat for business finance. Thank you.